Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com. Hi, everyone, and welcome to the RIA Edge podcast. This is, as you hopefully know by now, my chance to speak to executives at growing RIA firms with the aim of better understanding how they think about growth and the decisions they are making to build firms that successfully move from small, independently run practices to enterprise-level, sustainable, professionally managed businesses. Today, I'm speaking to Nate Lenz, who is the CEO and co-founder of Concurrent Investment Advisors. Many of you know Nate Lenz. Among other things, we talked about Concurrent's RIA Capital Partners program, which is now taking minority stakes in external RIAs, how this might help solve some of the issues that younger advisors have buying into their firms. We also talked a little bit about where Concurrent is at with their affiliation program and his views on advisor efficiency, issues around data, and why advisors need to own their data, not just facilitate the transfer of data between vendors. I always enjoy speaking to Nate, and I learn a lot about where his business is at and the industry at large, and I hope you do too. So here is Nate Lenz. The next generation thing is interesting because, it's obviously every advisory firm, is looking for next gen clients, right? Yeah. And that's, getting their hooks into the clients' kids and that sort of thing. And from your perspective, the idea of building or investing in or supporting advisory practices that are maybe ready to do that kind of thing, how much does that sort of work into your thinking when you're looking at firms to partner with or potentially make an investment with? And we can get to some of that too. But their readiness, I guess, for that great wealth transfer that we've all been talking about for years.
Yeah, I would say that there's kind of haves and have-nots from what I've experienced. There are firms that are really actively engaged in meeting with the next generation and kind of doing that multi-generational planning and facilitating family meetings, or that are specifically targeting and marketing to next generation clients. I would say that it's kind of a have or have not, right? Or firms that just aren't, that have built their business over the last.
You say most firms are not.
Most firms are not, right? Those are probably a select few that are. Most firms are not. I would say most firms, and look, by the time you get to the independent space, most folks don't grow up here, right? They started at Morgan, Merrill, Wirehouse, 20 years, then went independent. Again, they have an established book of business. You look at the number one driver of growth, it's primarily referrals. Yeah. And, I would say that unless they're making concerted effort to market to that audience, their books continue to look very much the same. Yeah. Right. And I think I do think at the end of the day, when we're looking at it as a potential acquisition opportunity, even if we're making a minority investment in that business, right, it's something that we want to understand. Okay, well, how can we ensure that this practice is sustainable over the long term? Now, I think we still have some time. I know there's a lot of talk of the generational wealth transfer. Like, the money's not going to end up in the hands of millennials all tomorrow, right? You've got the kind of the horizontal wealth transfer first going to the spouses. And then from there, really the boomers are kind of the next piece. So I don't think it's not imminent, right? Where unless you're catering to millennials and Gen Z, you've got a problem. But I do think it's something to be thinking about, that the clients of the future, right, are the ones that are on things like Robinhood today and things like that, versus the clients that we're accustomed to serving, which engage differently. I think it's one of those things that we have an eye on, that we're looking at with firms. I think we definitely place value on the firms that are considering the next generation. But I think if they're doing it as part of holistically serving that household, that's where it carries the most weight. I think aspirationally, being a millennial myself, speaking to my demographic is interesting. I don't think that moves the needle necessarily in the next 10 years.
Okay. So it's not so much, let's create a program specifically for millennials. It's more about, let's look at the entire household of the clients we're serving. Correct. Which may include some millennials.
Exactly.
Do you think about if I'm an advisor either coming out of the wirehouse today or from another RIA that's looking for a support platform or something to help with, that I have a lot of options. If I'm a younger advisor, is there something that I'm looking for that's different maybe than that traditional boomer advisor that you were just talking about that came out of the wirehouses? I mean, in other words, has the advisor expectation changed?
Sure. I think it depends on where that younger advisor is in their career, right? If they have an established book of business and they're looking at moving to the RIA space, they don't necessarily want to reinvent the wheel and create a tech stack and a platform themselves, then I think a priority for them should be ownership of their business because they've already built something that has value, and being able to call it claim ownership of it and moving to the RIA space and keep ownership of it, I think is an important piece. If they don't have an established book of business, then I think it's much more about what types of career pathing would be in place, what type of mentorship opportunities would they have. We're big believers in our organization. That's why we set our business up the way we did, in the idea of independence, not just in business model, but objectivity of advice. And I think, most of the firms that we're serving are going through this transformation where they've built a book. Now they're learning how to operate a business. It's that practitioner to CEO shift. I think we're particularly good at coming alongside of them in that process. So that's when we're talking to younger advisors. We have one here in New York City, Ramin Abrams. He's in his early 30s, right? He's built a great book of business. He specializes in working with influencers and folks in the entertainment industry, and he's built a great niche for himself. That type of a candidate, right? There's not much that we're going to be able to do to help him move the needle from a growth standpoint in the niche he serves. Where we can come in is really provide all of those platform resources so that he's not spending time in those areas, the ops, compliance, tech, finance functions. We're able to professionalize and come alongside of him on his investment offering. We're able to provide planning support and paraplanning support to handle the more operational functions of that. But at the end of the day, what makes him unique and best equipped to serve that niche is him. And so I think for a younger advisor that's looking to make that transition, look for a firm that's not going to disintermediate you from your niche. Look for a firm that can help prop that up and support those efforts.
By taking some of those more onerous tasks of running the business off the plate. And
exactly. That's the stuff that's scalable, right? Like we can centralize and scale those functions. If you think about it from, the core elements of a wealth management offering, from investing to planning to client service, there's really a front stage and a backstage component to each of those. Our focus is on delivering the backstage and allowing them to differentiate themselves in the front stage. I think as a younger advisor that has an established book that is looking for support offerings, it's who can take that backstage piece off my plate in a way that allows me to really focus on honing my craft and growing my business in the way that I've already established and know how to do.
You recently instituted a program to take a minority investment in some of the firms that you deal with. Explain to me why you thought that was a good idea.
Yeah, so we actually rolled that program out in 2020. So we've been at it for a little while now. We took on a minority investment from Merchant Wealth Partners back in 2020. We leveraged that capital to then start to make minority investments in the teams that are on our platform that chose to participate. So it's important, I guess, first point is it's entirely optional. No firm, it's meant to be evaluated on its own merits. If it makes sense for them and their business, great, but meant to be looked at separate and apart from our core platform offering. And that was important, right? Because these folks are going independent. They're independent for a reason. We're not looking to ultimately force them into any type of equity sale within their business. It has to make sense. What we're finding is that, and I've seen this over the last 5 years, you've really kind of seen the pendulum swing. When we were first out there talking about this with our advisors, in a lot of cases, it was a foreign concept. I don't want to sell a piece of my business, right? I'm still growing. I've got a long runway ahead of me. I don't want to sell anytime soon. Why would I do that? What's been interesting is as they've understood the model and what we're trying to accomplish with this, ability to provide windows of liquidity for them to solve different needs if and where they want it, I think that's now been seen as attractive and it's become more commonplace. So the pendulum's definitely swung where 5 years ago you got the stiff arm in that conversation. Now every prospective team that we're talking to is asking, like, what's your equity model? How does it work?
Okay.
Which is as I think made it a lot easier, right, to get deals done. But I think you're also seeing when it comes to the reasons for doing it, we tend to see kind of three archetypes. You've got firms that want to de-risk, want to take some chips off the table. I think that's been proliferated in a lot of ways by I'll call it private equity backed roll-ups, right, that are out there making offers in the marketplace and have driven multiples up to a meaningfully high level. And so you've got this subset of advisors that have looked at those types of deals, then taken a step back and said, okay, it's not for me. I'm not ready to put on the fatigues and salute the flag, but I see the benefit of potentially taking some chips off the table. So that could be a good use case for it. in addition to that, you see a lot of firms that are looking to facilitate internal succession. I think that's a big problem that we have right now in the industry, is that because of where multiples have drifted to, even on, call it subscale practices, what you have is an affordability issue for the next generation, right? Which is presenting a problem for a next gen advisor to pay 8 to 12 times EBITDA for a practice when they don't have a book of their own that they can ultimately use the cash flow from to subsidize their living while they're trying to complete this purchase, let alone it won't hit the credit metrics needed to get debt financing. It's not affordable at those levels. So what I think that's created is there are certain sellers in the marketplace that are looking to maximize value. That's perfectly fine, right? But if they have next gen advisors in place, it's really putting them in a precarious position, because they may wake up, go to sleep on Friday being the heir apparent to their firm and wake up on Monday being an employee of a roll up, not by their own choice. And so I think that long term, retention will be the task for those organizations. But I think it's putting this kind of next gen in a precarious position as to their place in the world as a result of it. Our model, I think, can help solve for that, because we can come alongside of that next gen, co-invest with them to acquire the business from the retiring partner, but do so in a way where they're able to ultimately maintain control. And I think that that's a unique use case that we're seeing increasing pretty heavily. And
so how does it differ when you say come alongside the next gen to make an investment in the business without them giving up control? How does that differ from what traditionally was just a small investment in the, in the firm? Is it structured differently?
It's not structured any differently, right? We're just using it. Typically, it's in combination with also a debt facility provided to the successor. So, for example, when we typically onboard a team, if they choose to participate in the partnership model, we're acquiring between 10 and 25% of their top line revenue. We express it that way because it's easy to think in those terms. As an organization, we're willing to invest at the revenue line, at the EBOC line, at the EBITDA line. Really, the only thing that changes as you go down the P&L is our level of budgetary controls. If we're participating in bottom line profitability, which we'll do in certain instances, then we have to approve an annual budget, for example, right? Because we're affected by that. For most practices that come on board, we're acquiring a stake in the top line revenue of the business, which allows them to maintain full control of their expense structure without our hands in any of it.
You're essentially just buying a bit of the revenue.
Exactly. We're just buying a bit of the revenue in that structure. So when it comes to this facilitating succession model, we're doing the same thing. So give an example, we have a firm that we've worked with out of Texas. It's a senior advisor that's been in the business for 30 plus years. He has a junior advisor on his team who's been with him for 16 years. It was important for him that she be the successor of the business, and that he puts her in a great spot. And so we started looking side by side at, okay, if she was going to buy your business today, just with normal financing opportunities, with an SBA loan or conventional loan, what would that look like versus our model? And so in the buy it standalone scenario, I asked him, all right, well, what do you think a fair multiple is for your business? He said 2.5 times revenue. Great. Like you can absolutely do that deal. That you can debt finance, that can work. So he was doing 2.5 million of revenue. That came out to $6.25 million is what he was looking for. So we said, okay, let's say she goes and finances the full $6.25 million on a 10-year term at SOFR plus 450. Okay. Well, the debt service on that note came out to something like 43% of the top line revenue. So she's giving us a meaningful amount of the cash flow, and she still has the operational expenses, the office, the support staff, et cetera, of the business.
It's a tough nut to take on.
It's a tough nut to take on. And that's a very reasonable valuation, right? When you start to get to the 3.5, 4x range, all of a sudden, that becomes unaffordable. So we looked at that side by side with our model. And what we proposed in the way that our structure works is we're typically taking a minority investment. So we're giving them cash and equity for a small minority equity stake in their business to start. So it might be 10% of gross revenue in this example. So we're stepping in, we're buying 10% of gross revenue. He's getting mostly cash and a little bit of equity and concurrent in that transaction. But as part of every one of those deals, and this goes back to that concept of creating windows of liquidity for all the teams that are part of our partnership, he's getting a tag along right alongside of us in any future monetization, recapitalization that we experience. So what we illustrated for him was, okay, if we buy 10% today and we give you the cash and equity, and then ultimately in this next window of liquidity, you choose to sell more, how much would you need to sell and at what multiple to get you to the same point.
Okay.
And if we looked at, okay, hey, if this next window of liquidity that opens would come at called a 15x multiple, because that's the concept with the tag along is they're selling a small minority piece in their business at, call it market multiples, in order to get access to these outsized multiples, which are facilitated through collective monetization alongside of Concurrent.
Okay.
So if the typical practice sells for 4 to 7 times EBITDA, and you've got, the roll-ups are buying it, call it 8 to 11, at scale, aligned integrated platforms might sell at 15x plus.
Okay.
So the math behind it is, okay, you get to sell as we open these windows of liquidity, you're able to sell more alongside of us at these higher multiples. So fast forward 3-4 years, let's say you choose to participate in this next window of liquidity, you sell to get to the same $6.25 million, he would have had to sell 14% of additional revenue.
Okay.
So in total, he sold 10 up front, right? He sold another 14. Between those two transactions, he sold 24% of top line revenue. He still owned 76%.
Mm-hmm.
He got the same $6.25 million, right? Versus her being under the storm cloud of a 42% of gross revenue debt service payment. So now what he does from there is up to him. He can be as accommodative as he wants in handing the business to her. But in all situations, because we're co-investing alongside of her, and we'll provide the debt for her to pay whatever portion she's looking for in this example. But what we've created is an outcome where he can get like or better proceeds from his business, leave her with more cash flow, and more importantly, leave her with a partner that can handle those back office, middle office functions and operations for years to come, a lot of which is what he's doing.
And the success of that will depend on the success of Concurrent.
Sure.
You talk about that next liquidity window. That's,
And I think, and when we were doing this 5 years ago, right, it was very much a matter of if. It's like, okay, hey, if we can grow to a certain size and we can bring these businesses together, that'll get us to scale, and then we'll be able to facilitate this. I think when you look at where we've gotten to today, so we just crossed 14 billion on the AUM side. We've also got an additional 18 billion in AUA in our retirement plan business, which I know we've talked about in the past. So, we're at scale, right, and growing and making meaningful investments in our infrastructure to make sure that this business is durable. So really the conversation has shifted from a matter of if to a matter of when. And I think that's lended a lot of credibility to the story, because they can look at our business, they can look at comps for our business, and they can see, okay, it's realistic that in any recapitalization event that, Concurrent can demand these multiples. That I think lends a lot of credibility to that discussion.
Is it dependent on market appreciation remaining as robust as it has been? I mean, we've been talking about for years. It's like, well, things are going to turn because they always do, and it's inevitably there's a business cycle, and it's got to retreat a little bit. It still hasn't really seemed to happen.
It hasn't.
But if we're due, how much does that throw a wrench into this?
Yeah, it goes back to the kind of the conversation of like, what's growth net of market? What's growth really been net of market in the RIA space? And I know that some of the stats that I've seen out there have been low single digits, right, net of market. I do think when you look at our underlying advisor base, we tend to skew younger than industry average. A lot of our firms are still in growth mode. That minority investment structure that we have lends itself to that, because they're able to have the upside opportunity that comes with a traditional roll-up without giving up control. And they're able to do so with a lot of flexibility and optionality as to how much and when they choose to participate. And so that can attract the 30-something right up through the 60-something from a model standpoint. So I do think as an organization, we're a little bit insulated. We're not fully insulated from it, but slightly insulated from it, because I think we do have above industry average growth rates. And our firms are very much, they're not white flag businesses. These are firms that are still in heavy growth mode. But, as is in anything, as I think we've also, as an organization, we've gotten past that inflection point where major market downturn no longer poses an existential threat, right? It may change our timelines and some of the things that we're investing in as an organization. It may change the viability of certain outcomes, right? And so I think that all would play a factor in how this all comes to pass. But I feel much better about our position and standing today than I would have 5 years ago, when it was more of a matter of if than when.
More of a durable business at this point.
Exactly.
And you think those future monetary events, and we've got other stuff to talk about, and we can get off this in a second, but those future monetization event that you talk about that would fuel some of this and help. What would that look like? Would that just be a merchant selling to another firm, or would that be yet another investment from another private equity firm or private equity-backed banking entity of some
Sure.
sort, or IPO, or what?
Sure.
What is
Yeah. So I think there's a couple different branches of that decision tree. One of the great benefits of being a partner of merchant is that they are actively pursuing strategies to access liquidity at the merchant level. So whether that's a merchant-led IPO or merchant facilitating private market access on a regular basis, in line with like what we're seeing SpaceX do, right? They're regularly accessing the private markets to raise capital and facilitating it in that manner. Our friends at Merchant, right, are actively working on those strategies for their own capital raising efforts. I think you've also seen in the last round of capital raising from Merchant, you saw Sixth Street enter the picture, and Sixth Street, out of their kind of go anywhere, do anything vehicle. I think there's, that was a great validation for what they're building. So I think, what's great about the relationship is, and look, they've got a tremendous amount of experience in that from the executive chairman level. Mark Spilker and Scott Prince both were Goldman through the IPO. Spilker took Apollo public. So in terms of educating the public markets on what that entails, they've got a tremendous amount of experience and would be in a great position to get the right institutional shareholders to the table in that environment. Right. I think the private market piece presents an interesting opportunity as well. There's a lot of talk in the whole democratization of alts conversation, less and less listed companies, and all of a sudden you've got so many of the companies are held by index funds, and how that affects trading. And so I think there's definitely merits to the private markets as well. And that's a path that they're going down the road. They're able to focus at that level. At the concurrent level, we're focused on what we can control, which you mentioned, building a durable business. That's front and center. We're making a 7-figure investment in data infrastructure right now. I think that's something that we know we've got to get clean data. We've got to have it in one place in order to be able to leverage these tools that are coming. And so, from our perspective, we're very much focused on what's going to make our business successful 10, 15, 20 years down the road. If we do those things correctly, valuation will take care of itself. But the underpinning of our deal, right? Merchant's a minority investor in our business. And so we have a lot of optionality ourselves. And I think we've seen, in previous situations where Merchant has really been an investor in a business, but because the founder wanted to access liquidity in some way, they actually kind of took off the investor hat and put on the banker hat and facilitated a transaction. Right? We saw that with Paragon. We've seen that with a few others over the years. And so I think that it's all these different kind of layers of optionality are really attractive. And I think it's the same are available to our underlying advisors. And that's what I talk to them about all the time. It's, hey, let's build your business, right? To meet what you're looking for from a lifestyle perspective, to meet your growth objectives. If you want to build an enterprise, let's talk about how we start to do that, and the importance of hiring and developing and bringing along and incentivizing talent, right? All of those things play a factor. If they're doing all the right things at their level, then they have a partner in Concurrent, right? Which is focused on how can we access the capital markets to create liquidity for them. And we've got a partner at Merchant, right, doing it at that level. And we get the benefit of that optionality kind of all the way downstream.
All the way downstream. You talk about the investing in the things that you need to do now to help those partner firms be sustainable. I imagine a lot of these firms, especially ones coming out of the wirehouse, or even some that are coming from other RIAs, really good with clients, good at what they do in terms of financial advice and financial planning. Not the entrepreneurs, not running the business, looking maybe for like a bit of a blueprint on how to build their business in a way. I mean, one of the things that we're thinking about a lot more is, what is an efficient RIA? What does that look like?
Yeah.
How many clients per advisor?
Sure.
How many,
Sure.
What do they expect? What are the benchmarks that should be?
Yeah.
Do you think about that at all? Like,
Yeah. No, absolutely.
And how to help these advisors maybe get to the point? I mean, do you have to tell them, well, actually, you should be having, 150 clients per advisor,
Sure.
not just 100, or whatever it might be.
Yeah. I think the nuance lies in what is the profile of the underlying client they're serving, right? And we saw that on the panel that we were on together a couple of weeks ago when you looked at Dave or Matthew and like what the businesses that they've built relative to ours. You've got ultra high net worth where, they're getting to 50+ billion of AUM on a relatively small number of households,
right,
versus, a typical firm within Concurrent that's serving a mass affluent client base. Then I think those traditional metrics of how many relationships can you really service effectively comes into play in a much stronger manner. So in our world, because our typical client size is that 1 to 5 million, we have teams that play in the high net worth, ultra high net worth space. We have teams that focus on the professional athlete niche. So we definitely have some specialist firms that, but in mass, we're a mass affluent business. Mm-hmm. And with that, I do think a lot of those traditional metrics do carry weight. And when you start to think about, all right, where do they start to hit capacity walls in the growth and development of their business? I do think, we talk a lot about the rising demand for wealth management. I think clients are getting bigger, right? We've had the benefit of rising markets for a number of years. So where the metrics used to be maybe, 150 clients and 100 million of assets became the point where you need to start thinking about adding either, additional specialists on the team or a relationship manager, advisor, G2. I think those numbers are higher now. Like we're seeing a lot of successful solo practitioners with, sales support that are running, $250 to $350 million books of business. Mm-hmm. I do think at that level, you start to really see a need for starting to build out the team. Mm-hmm. But one of the things that we found to make those businesses more efficient is rather than trying to replicate themselves, them going out and finding other professionals that can fill different roles within the team. And I think that specialization and being able to take the team approach makes their business more durable. Also, clients are looking for that. They like that team approach structure. So rather than it being, the old model of, 1 to 3 advisors sharing a support staff person, that's really sales support, where the advisors are all responsible for the building out the portfolios and handling all the planning and prospecting and handling client reviews. I think what you're starting to see now is more of a, 1 or 2 over 3 approach where they end up having, a sales and operational support person. Maybe they've got a financial planner. They've got someone supporting them on the portfolio side. So you're starting to see more of that model. And I think that better serves clients in a lot of cases and allows them to scale to greater size. And it also affords them the opportunity to start training that next generation in an apprenticeship manner to be in a great position to be a succession solution for them if and when the time comes.
So almost as the, I guess we used to call it a lead advisor. Maybe we're not using that term anymore, but advisor as the relationship manager. There's the kind of the point of the spear out there in the world, and then supported by a staff that has more specialized roles.
Exactly.
And in your world and Concurrent's world, would those specialized roles be inside the RIA that you're dealing with, or do you bring some of those people to your partner firms?
So I think the answer is both. Mm-hmm. Right. I would say in some of our firms, they are actively building out ensemble team structures with lead advisors, relationship managers, and special advised roles in the field. We have other practices that are operating as sole practitioners that may not be ready to make that investment in the human capital in order to build that out, might not be at the scale to do so, and they're reliant on us to do it. The ideal career pathing for someone that comes into our organization, sits on our planning desk and is supporting teams from a paraplanning perspective, they'd be a great resource for that solo practitioner that's not quite ready to take the plunge, right, but wants a great resource that'll give them capacity. A great career path for that individual is to work through our organization, come on the planning desk, ultimately kind of help serve our house accounts, right, internally. From there, they could potentially take a career path within our corporate solutions program, which is serving our underlying 401k plan participants, or they could go out in the field. And we celebrate that because we have ownership stakes in all these firms that are out in the field. And if you think about our model, let's say those firms are coming to the liquidity window and accessing it. Well, the way our structure is set up is that once they've exhausted that tag along optionality, they've sold us 49% of their business, right? And that's intentional. We want them to maintain the other 51% at a minimum because we want them still in the seat or their named successors in the seat to control and run the business. But in that scenario, we have significant incentive to make sure that business is sustainable. Mm-hmm. So for us, we celebrate, hey, if we can train and develop someone internally, and they can help support our advisors in the field, and then they can be deployed into one of these practices that wants to build out this ensemble team, that's the best possible outcome.
And would that be as an employee of yours or an employee of theirs?
As an employee of theirs.
Okay.
Yep.
Mm-hmm. Exactly. We've talked before too about this, notion of the support platforms, I guess what Hightower used to be, what Dynasty still sort of is. And I think Dynasty is kind of a model for what you're doing, moving closer to the economics of the client, the end client, right? So, and you're taking a stake in some of the firms, and that's maybe a move towards that. Is there a point maybe where you bring on some W-2 advisors, the concurrent advisors as W-2 employees?
So we are bringing on associate advisors. I would say we're not bringing on any experienced advisors as W-2s. That's not part of our business model. It won't be.
Okay.
Right. We view ourselves as we are building. Yeah. We don't intend to make any major shift. We've seen some firms do that as of late, where they've gone from 1099 platform to W-2 partnership. That is not in the cards for us. We view ourselves as a haven for entrepreneurs. We see what's going on with the private equity backed roll-ups that can provide a perfectly fine solution for the advisor that ultimately needs a succession solution, wants to monetize their business. And in many cases, those firms can better serve those clients anyway, because of all the holistic resources that they have and can bring to the table. The advisors that are a great fit for Concurrent are the ones that still have gas in the tank, that are entrepreneurial, that are ultimately, they want to build a business. They view us as additive in helping them craft that business plan, build out their team, et cetera, execute on their growth strategies. That's our archetype of advisor. And so, at our core, right, we are a platform and will always be a platform. Now, we see an opportunity with our minority investment model to create further alignment, right? And so I think that's the nuance here, is that by us making these investments in their business, them getting cash and equity in our business, we're now aligned as partners. We're no longer just a vendor to them. And then what that allows us to do is really put our ear to the ground and understand, okay, as a partner in your business, what's going to help move the needle the most? So going back to that framework, by us focusing on the backstage elements, and that's where we're hearing the demand. We need help with training. We need help with data input in the construction of financial plans, right? We need help on the investment side. That's another big push. I know before we jumped on, I mentioned I'm heading out to Denver to meet with one of our teams after this. It's really to start to work with them on leveraging our investment team to its fullest extent. In doing so, that conversation is not use Concurrent's models. Right? It's our process is to come alongside of each individual firm as their OCIO, help design an investment program, an IPS, so to speak, for their business, facilitate an investment committee consisting of their advisors, right? So that they've ultimately have their hands on the sticks, and then hold them accountable to that. But it's our back end research, implementation. They're leveraging our different sleeves. We call them wealth blocks off the shelf to create modular portfolios to serve different client outcomes. At the end of the day, we don't want them choosing, which large cap value manager is the best. We want them talking about advanced planning topics and different client situations that they need to solve for. Let our team handle the back end research, implementation. Let's deliver it on UMA technology that gives them every arrow in the quiver. But again, I think that's indicative to how we think about things. Those are all the backstage functions. But we want to incorporate their views on the front stage and let them be the tip of the spear in terms of how they're interacting with clients. I think that is kind of a microcosm of how we think about our business in mass. We want to take the backstage, keep them on the front stage, because we think that gives us the best opportunity to grow as an organization over the long term.
You talked earlier, and I know we're kind of running out of time here, but the data component and what you're building out there, and that seems interesting to me, because we heard more about advisory firms kind of taking control of their own data, owning their own data, bringing it in-house. How does that work at Concurrent? Where do you see sort of the data conversation for RIAs now versus what you maybe envision should be the case?
It's interesting. So, when we launched the RIA a little over 3 years ago now, one of the great advantages of the RIA space was, hey, everyone's got open APIs, right? And so, great. So we linked up our custodian to our CRM system, to our reporting system, and so forth. And it's great. It's all got open APIs. It's a huge selling point. In practice, yes, those systems, there's data that flows between those systems, but you end up with a little bit of a game of telephone, right? Where it comes out of the custodian into the reporting system, into the CRM. Some of the fields don't line up properly. It doesn't come back. And when you're magnifying that by, call it 76 practices around the country, 145 underlying advisors, right? That becomes a little bit of a tangled mess.
A lot of chaos.
And so that's what we've experienced over the last 3 years. And we've done our best to sort through that. And we've got really workable solutions working with our vendors and partners in that regard. But there really is no replacement for owning your data, having one central source of truth, being able to leverage that to tighten integrations between the existing systems. And frankly, what you've seen with all of the new AI tools that are coming to the table, right? That's like the prerequisite. And so I think that's raised the stakes. It's how fast some of these new tools have come to bear is what's really, I think, forcing RIAs to accelerate their investment in data infrastructure just so they have a place at that table and can use what's out there.
And when we talk about investing in data infrastructure, we're not just talking about simply, more data in the spreadsheet. I mean, you're talking about bringing data onto a server that's owned by the.
Yeah, so it's all. So we've worked with Invent to build out our data lakehouse, and so essentially they've been building the underlying instance of Azure for us, and then building the front end that allows us to query the data in the way that we need to leverage the appropriate tools. So it's, to your point, it's not just adding more stuff into the spreadsheet.
Yeah.
It's that underlying data lake house infrastructure that we've created. That's where the investment is.
And is this yet a selling point for some of the firms that you're talking to about coming onto the platform? The idea that you're making these kinds of changes, or is this still something that's for most RIAs a little bit off the radar because they're just doing as much as they can?
I think it's still, because where that stuff manifests itself is in the end tool. It's like what you put on top of it, right? The data lake in and of itself is not all that sexy. But it's what you can do with it once you have it. So I would say it's still largely under the radar. What I think I found it more productive in conversation to do is it really demonstrates, again, our long-term focus. I think there's a lot of models that have come and gone over the years that are looking at, let's just aggregate assets and hand it over to the greater fool, right? Like is the model. I think what our investment in our data infrastructure, as a small example, is an example of is, look, we're in this for the long haul. We're going to be here 10, 15 years in the future. Any opportunities to open the liquidity window are there just to advance our goals and objectives and those of our underlying advisors. But we're really focused on building a long-term business. And I think that's what it signals.
Okay. Well, Nate, this has been great. I know we're kind of at the end of our time, but I appreciate you coming in.
Thanks for having me.
Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com.